Welcome to this edition of the Well-Caffeinated podcast. Today we will be discussing the current retailization boom in private capital, and in particular, how private capital investment advisors can successfully manage the risks of managing retail products and retail investors. Private capital is definitely experiencing a retail moment. Total assets under management, or AUM, for U.S. private capital products topped $400 million in 2024 and is expected to double by 2029. I'm joined today by four colleagues who will help us unpack the issues associated with managing retail capital. First, Melissa Hodgman. Melissa is a partner in Freshfields' Washington, D.C. office, whose practice focuses on white-collar defense, SEC enforcement, global investigations, and strategic risk. Before joining Freshfields, Melissa spent more than 15 years at the U.S. Securities and Exchange Commission, including serving as the acting director of the SEC's Division of Enforcement and as an associate director in enforcement, where she supervised high-profile investigations involving disclosure fraud, cybersecurity, crypto, insider trading, and market manipulation. Next, we have David Nicolardi. David is a partner in Freshfields' Washington, D.C. office, who advises private fund advisors, investment advisors, and financial institutions on SEC regulatory, compliance, and enforcement matters. Prior to joining Freshfields, David served as branch chief in the SEC's Division of Investment Management, Office of Chief Counsel, giving him deep insight into the regulatory issues affecting private funds, retailization, and investment advisor oversight. Third, we have Andrew Gladstein. Andy is a partner in Freshfields' New York office and a member of the firm's commercial litigation practice. Andy focuses on complex commercial and securities litigation with significant experience representing private capital managers, alternative investment funds, and public companies in high-stake disputes, investigations, and regulatory matters. Finally, Jeremy Barr is counsel in Freshfields' New York office, where he focuses on capital markets and securities law matters. Jeremy advises issuers, underwriters, and investors on public and private offerings, including offerings involving BDCs and other investment company regulated vehicles, making him particularly well positioned to discuss the capital markets and product structuring dimensions of retailization. Melissa, David, Andy, and Jeremy, the name of the podcast is Well-Caffeinated, so I'm obliged to ask, what is your beverage of choice this morning?
So I'll start. I'm going with a flat white, but my special add is Vietnamese cinnamon.
Great. David?
Thanks, Tim. I have a double espresso to make sure I am fully caffeinated on this Monday morning.
That's great. How about you, Andy?
I'm running on some extra sugar this morning.
As you always do. And Jeremy?
Iced cappuccino.
Iced cappuccino. So for the record, I'm having an iced latte. The iced part is needed today because it's a really hot day in the Big Apple. So let's get ourselves started. Question one is for you, Jeremy. How do investors in retail private capital vehicles differ from traditional private capital investors? And what are the primary types of vehicles or products used for the retailization of private capital?
When we're talking about retailization, the headline is greatly expanding the universe of potential investors in private capital and private credit products. And part of that means that retailization includes products that are available to natural persons and not just institutions. And part of that is about the nature of retail private capital vehicles and making structured vehicles attractive to investors with shorter time horizons than typically invest in traditional private capital vehicles and investors with a greater need for liquidity than those who invest in traditional private capital vehicles. By way of comparison, when you look at traditional private capital, many funds that invest in private equity and private credit are structured to comply with the Investment Company Act exemption under Section 3C7. And that means that the funds are offered on a private basis and that they're limited to qualified purchasers. Qualified purchasers are individuals with $5 million or more in investments or institutions with $25 million or more in investments. And so very high net worth individuals and well-capitalized institutions. The way that many private equity funds work is they have a life of 10 years or longer and provide very little liquidity for their investors during the life of the fund. And so investors need to be comfortable committing their capital for an extended period of time. In addition to that, investors in traditional private capital vehicles can be called on to fund their investments in multiple stages. And so they work best for institutions that have a lot of capital to deploy and are comfortable being called on to fund investments over an extended period of time. When you look at retailization and retail private capital products in contrast, first of all, many funds are offered on an SEC registered basis, which can allow for general solicitation and a broader solicitation of potential investors. And many of them have lower investment eligibility criteria. There are many retail private capital funds which are available to accredited investors. And accredited investors, in contrast to qualified purchasers, require $200,000 a year of annual income or $300,000 a year of annual income with a spouse or $1.1 million net worth. And so there's a much broader universe of investors who are able to invest in retail alternative products. And unlike traditional private capital funds, where you can be called on to fund an investment at multiple times, typically in retail alternative funds, investors are purchasing shares at one time. And so you don't have the issue of needing to retain capital to fund it multiple times. Perhaps most importantly, given the evergreen structure of many retail alternative funds, which we'll talk about more, that many of these funds have perpetual lives, they're able to allow a level of liquidity to investors by permitting periodic tender offers or their shares to allow investors to take back a portion of their capital over time. When we look at the products that are offered in the retail alternative space, the funds tend to be organized as one of three versions of a closed-end fund. There are tender offer and interval funds and business development companies. Tender offer and interval funds are registered investment companies under the 40 Act. Business development companies are regulated under the Investment Company Act and operate under a hybrid set of rules, some of which apply to registered investment companies, some of which apply only to BDCs. When we look at tender offer and interval funds, they tend to engage in a continuous offering, meaning that they're able to continue raising capital over time, and they provide a measure of liquidity to their investors by undertaking periodic tender offers. Interval funds commit to tendering for their shares on a periodic basis, and tender offer funds allow the fund a little bit more flexibility and undertake tender offers at the direction of their board. BDCs come in a number of different forms. There are listed BDCs, there are unlisted BDCs, there are private BDCs. Some of their key characteristics is that they need to invest 70% or more of their capital in eligible portfolio companies, which are either private companies or companies with a low market capitalization. And they also need to make available managerial assistance to their portfolio companies. So that's a brief overview of the investors and the key products.
Thanks, Jeremy. That was very comprehensive. David, what are some of the key regulatory obligations for retail vehicles and products, and how do they differ from those applicable to private funds that traditional private managers are used to?
The retail vehicles, the interval funds, tender offer funds, and the BDCs that Jeremy mentioned are subject to more regulations than private funds, and the nature and extent of disclosure documents are more prescriptive for these retail vehicles than for private funds. Also, there are substantive obligations that apply to retail vehicles that do not apply to private funds. In the private funds context, the issues that are addressed by these regulations would be determined by privately negotiated fund documents, and the sponsors and the investment advisors are going to have more leeway regarding the substance. Specifically, Retail vehicles are subject to the Investment Company Act. In contrast, as Jeremy mentioned, private funds are excluded from the definition of investment company and thus are not subject to most of the Investment Company Act requirements. Retail vehicles are also typically registered pursuant to the Securities Act. This means that the retail vehicles, unlike private funds, will publicly file certain disclosure documents with the SEC. That's one significant difference, the sponsors and the advisors of retail vehicles as opposed to private funds. In addition, as I mentioned, retail vehicles are subject to substantive obligations of the Investment Company Act that do not apply to private funds. I'm going to briefly discuss several of these obligations that are specific to retail vehicles and may be new to investment advisors that traditionally manage private funds. First is a requirement to have a board of directors. Retail funds and BDCs are required to have a board of directors or a board of trustees, and the majority of them must be independent. The board is intended to serve as a check against conflicts of interest and is required to approve the advisory contract with the investment advisor. The board also plays an important role in valuation and in administering the redemption process that Jeremy talked about earlier. Second is valuation. Retail funds and BDCs are required to determine valuation of the securities they hold on a quarterly basis. For securities without a market value, valuation must be determined at fair value. The Investment Company Act requires fair value to be determined by the board, which we just discussed, or by the investment advisor if they're designated by the board to do it. And typically, the board will designate the investment advisor to make these fair value determinations. The Investment Company Act also establishes certain processes and documentation that need to be followed determining fair market value. For retail funds that are investing in private capital, valuation is particularly important. As Melissa is going to talk about, we're going to discuss, valuation can present significant regulatory challenges for investment advisors to retail private capital funds. The next feature is periodic investor redemptions. Now, as Jeremy mentioned, interval funds and tender offer funds are required to periodically redeem a proportion of their outstanding shares. There is no such mechanism or requirement for private funds. Next requirement we're talking about are leverage limits. The Investment Company Act imposes specific limits on the amount of leverage that interval funds, tender offer funds, and BDCs incur. Private funds, on the other hand, often use leverage, and this can be a mechanism for them to boost their returns and to operate in their ordinary course. The last distinction I'm going to talk about, and which is a very significant one, is a prohibition on affiliated transactions. The Investment Company Act and rules prohibit joint transactions involving affiliates. So what this means is a retail private capital vehicle, a private fund that had the same investment advisor, jointly structuring and making an investment in the same company. That would be a joint transaction, and that would be prohibited by the Investment Company Act. Registered funds, BDCs, their affiliates, their investment advisors, may obtain an order from the SEC exempting them from this prohibition on joint transactions and permitting them to co-invest under certain circumstances. Over the long term, obtaining this co-investment relief can be critical for a retail fund invested in private capital if it's going to be invested in or managed alongside a private fund. It's also critical for the investment advisors, managers, and sponsors of these vehicles. We're going to turn it over to Jeremy, who's going to talk more about regulatory responses, including some important developments related to co-investment relief.
Thanks, David. Back to you, Jeremy. So generally, how have regulators and government authorities approached the retailization of private capital?
The takeaway here is that in the last couple of years, the Trump administration has taken a lot of steps to expand access to private capital investments and simplify compliance obligations. And there are a number of different examples that we can point to. As David was just discussing, one of the big ones is the simplification and expansion of co-investment relief. And as David mentioned, for a retail alternative fund managed by an advisor that also has private funds, they often need co-investment relief from the SEC in order to be able to allocate private capital or private credit investments both to the retail fund and the private fund. And the SEC has provided co-investment relief for many years, but it had a lot of very onerous components to it, which made it difficult to comply with and difficult to manage. And in 2025, the SEC modified the conditions that apply to co-investment relief to make it easier for investment advisors and their funds to operate under. Some of the significant changes that were implemented were that the range of specific co-investment transactions that require approval of a retail fund's board was reduced significantly. And the obligations of the investment advisor to report co-investment transactions that weren't allocated to a registered fund during the prior quarter were reduced dramatically. The new co-investment relief focuses on the registered fund board approving the policies that the investment advisor has implemented to comply with the new co-investment relief, in addition to reducing the reporting and approval obligations for the registered fund boards. The new relief also creates pathway with prior board approval for registered funds to participate in transactions that they hadn't previously been able to. In particular, investing in a private capital investment in which an affiliated fund had already invested in the prior funding round, or permitting a registered fund to invest in a private capital investment where they didn't participate in the original funding round for that investment. And in early 2026, the SEC issued a no-action letter rather than an exemptive order to expand this co-investment relief to open-end funds. And so this is clearly an area that the staff has been focused on reducing regulatory burden. Another modification of the SEC rules that we can point to is that for many years, the SEC had issued guidance which said that if a registered fund invested more than 15% of its assets in private funds, that it could only accept investments from accredited investors, and it needed to have a minimum investment amount of $25,000. And in 2025, that guidance was withdrawn. So in this example, the SEC is creating a pathway for investors who don't satisfy the accredited investor definition to potentially get access to registered fund of funds investments. Another example that we can point to is in August 2025, the White House issued an executive order to broaden 401k plan and defined contribution retirement plan access to alternative assets. And while the executive order didn't result in immediate rulemaking, it directed the Department of Labor to re-examine its guidance on fiduciary duties as they relate to alternative assets in ERISA-governed plans, and to clarify its guidance regarding a fiduciary's duties under ERISA. It also directed the SEC to, among other things, consider revising the definitions of accredited investor and qualified purchaser. And so in response to the White House executive order, the Department of Labor rescinded 2021 guidance it had issued that discouraged fiduciaries from considering alternative assets in 401k retirement plan investment options. And recently, on March 30th of this year, the Department of Labor released a proposed rule concerning alternative investments in 401k plans and other defined contribution retirement accounts. And among other things, the proposed rule would create a safe harbor for ERISA plan fiduciaries who included alternative assets, or what are termed designated investment alternatives in the proposed rule, in 401k plan and other defined contribution retirement plan investment options. The safe harbor would apply both for classes of investments that were included in the retirement plan investment options, and also the specific investments that were included in the options. And the key for the proposed rule is that it establishes a series of factors that ERISA plan fiduciaries need to consider when deciding whether to include a particular asset or investment option in their list of choices for the plan. And those options are performance, fees, liquidity, valuation, benchmarking, and complexity. It is quite possible once the proposed rule is adopted, we anticipate that it will create momentum for risk plan fiduciaries to include more alternative assets in 401k and other defined contribution retirement plans.
Great. Thank you. Melissa, you're up.
Yes, sir.
The SEC chairman has indicated a more measured approach to enforcement matters. More measured sounds good to me. Help translate what this means for an investment advisor that has historically managed private funds entering the retail private capital space for the first time.
Well, I'd be curious to know what each one of you thinks measured means in this context. I'll jump in the first place, but if anybody else has thoughts, I'd be happy to hear them, because I think it's evolved over time, particularly as performance has changed in the space. Chairman Atkins has made very clear that, as he said it, the presence of risk is not a ground for the perpetuation of exclusion. This is one of those spaces where he would like to see more investment, and he wants to see it both in retail and in retirement accounts, which I think is the dialogue that is currently going on and what Jeremy and David were describing. But I think the important thing to note is just last week, the new enforcement director, David Woodcock, said that the SEC is attuned to potential risks relating to liquidity, fees, valuation, conflicts of interest, with a particular focus on the emerging stress in private credit. So I think what measured means today isn't what it meant a month and a half ago. It continues to mean fewer technical or low impact cases, not the type of cases you saw in the Gensler era. You're going to see selective deployment of resources, but there's going to be a real focus on fraud. When I say fraud, I mean scienter-based fraud. I mean somebody actually lying, cheating, and stealing, as the commission has been describing it, and investor harm. It'll be interesting to watch what measured enforcement means as the performance of the funds is impacted over time. I think that retail investor harm is really going to be the gateway to enforcement. There's a lot of ways to manage those risks and a lot of ways to set things up, because the good thing about the SEC is it's not a substantive regulator. It just does disclosure. What it will really be focused on is whether or not disclosures are vague or incomplete or in some way misleading. And then what does the practice diverge from what has been disclosed, which sometimes we see when there's stress in a marketplace. And do investors' outcome match their expectations? I think that's going to be the most difficult one for people to manage. And I kind of look forward to talking about what we think those expectations are and how they're being managed with David.
Great. Melissa, we'll keep your feet to the fire here, and maybe we'll get some thoughts from some of your colleagues. What are some of the key regulatory risks or challenges for a traditional private fund manager launching retail private capital funds?
Well, I think that they're those topics that the new director of enforcement has mentioned. We can start with valuation. And when private assets drive retail NAV, valuation becomes a core investor protection issue. That is one of the areas that we've seen not just only in private equity and private capital, but across pooled investments, an area of focus for the commission and a place that they're bringing cases. David, I don't know if you have some thoughts on how best to mitigate that particular risk.
Yeah. So private fund managers have to deal with determining the value of illiquid investments. They're used to doing that. But what is the distinction, and building on the statements by Director Woodcock and others, is that valuation in the retail context, it can be different. It is different, has different implications because of who the investors are, but also for how the role that valuation plays. Where a private fund, if you're you make the investment, you will get valuation periodically as an investor, but typically the investments are being held until the end of the fund. But in a retail fund, investors are coming in and out at various times because they're typically continuously offered. And there is the opportunity for certain redemptions at times as well. So valuation can determine whether you're, quote, overpaying as an investor or not getting the fair value out for when you redeem. It seems to me that with the valuation in the retail context, really the emphasis is going to make sure that the valuation in real time is correct, that there's not an inertia to not adjust or be slow to adjust if there's signs of stress, and the incentive that there may be to not mark down, to not be as responsive to a change in valuation or in market conditions because you're expecting to hold the asset over the life of the fund. In other words, valuation isn't necessarily going to be a new challenge to investment advisors, but the stakes are higher having retail investors. Would you say that's a fair characterization?
100%. And it's moving into the real retail investor space and understanding their expectations and how to manage those expectations. That valuation piece then plays into the next piece that we should talk about, which is really liquidity, particularly liquidity if there's ever market stress or a liquidity event that creates issues for the ability to get funds out. Traditionally, this area has been a space where you don't have full-time liquidity. Sometimes you're locking funds up for 2 years or those types of things. So one of the issues that I think we will see is if there's a run on the bank type of situation that we saw in 2008 with some pooled investment vehicles, if redemptions were to exceed liquidity, there were gating, and whether or not there's good enough disclosure with regard to this, because that really is the ball game at the end of the day. David, what do you think?
Yeah, liquidity is really a key feature, to key distinction between the private fund and this registered fund. It's a key area of attraction to investors coming into it. So really liquidity and being prepared for market conditions to not be as favorable or for stress or numerous stresses to happen at once can be key. And disclosure in the document itself is a key part. But I think one area that maybe you're going to discuss, and I'll feed into it, is it's not just a disclosure, but it's also the distribution. And maybe if you could talk a little bit about how distribution, oversight of broker dealers, the importance of that in the retail private capital context, that'd be a great thing to discuss.
Absolutely. Distribution. I also think of it as suitability. Are the right people getting into the funds who should be there? Are they being missold or a poor fit for a particular investors? You have to make sure that the intermediaries really fully understand a product and are placing it in the right place. This is going to have, I think, heightened risk in the retirement space, in those retirement channels where there may be larger amounts of money involved, making sure that there is that strong oversight with regard to distribution partners and targeting on training and products, risks, and liquidity when it is being sold to people. But do you have other thoughts on that one?
Yeah, I would just say two things on that. First of all, the disclosures are important, but they're not the be all end all. They're the starting point, and the distributor, the oversight, the broker dealer is really critical. It's not enough to just do the diligence up front, say, oh, we're going to use this broker dealer, we're going to talk to them, we're going to see what they're doing up front. It's throughout the process. You talk about training and ongoing monitoring. So the oversight of the distribution and the broker dealers cannot be static. It has to be something that's dynamic. It has to be continual monitoring, because that can really be critical to monitoring the risk. There are examples from the past SEC enforcement actions where it's not so much disclosure documents weren't sufficient. It's that the distribution, there's the breakdown of what the document said versus how people, the registered reps, were trained or selling the product, and where the investment advisor or the sponsor may have fell flat, or where the SEC allegedly fell flat, was not in what was in the documents themselves, but in making sure that the products were understood and suitable to the investors that wound up buying them.
David, I think that plays into the last topic that I think we should talk about, which is another area of SEC focus generally, which is conflicts of interest and fees. We've really seen the asset management unit in the Division of Enforcement lean into these types of cases during this administration. It's one of the 3 or 4 areas that I think were identified early on by the chairman as areas of focus. Whether those fees are layered or opaque, or somehow an investor is surprised by them at some point in time. With regard to conflicts, are they fully disclosed? Are affiliate transactions an issue in the structure? Does the actual disclosure reflect the actual practice? But that's the final area where I think we may see the first cases in this area, but I don't know what you think.
Yeah, fees, that's money coming out of an investor's pocket. And when you're talking about impact on investors, that is really consistent, I think, with the approach that this SEC will take. And everything that you said about conflicts and fees are correct. I think the other conflict of interest to think about and how fees play a role in this is investment allocation. If you're a manager and you're managing a private fund, and you're managing a retail fund, both may have similar objectives. There could be investment that's suitable for both. How are you going to decide which vehicle gets to make an investment if the investment can't be split or there's limited opportunity to invest in it? Are you going to pick the private fund because it might be paying more, pay an incentive fee? Are you going to pick the registered fund because you're trying to get that off the ground? Are you going to be influenced by potential where you are in the life cycle and carried interest and things of that nature? That's another area where investment allocation policies need to be robust, monitoring needs to be robust, and where the SEC has tools now to look at cite patterns of where conflicts or fees or investment allocation might not be matching up with disclosure. So absolutely, conflicts of interest and fees are going to be a big area of importance in all the areas you mentioned, in addition to allocation.
Yeah, and I think we've already seen that allocation issue a couple of times now, so that is well taken. I do think the SEC is opening the door to retail participation very widely, but I do think that firms are kind of in a rock and a hard place, and with regard to how the SEC is going to push towards opening it up, but also the enforcement piece that they're going to bring in. And I think firms will be judged on whether they disclose, then their disclosure matches what investors actually experience, especially in stressed conditions. So, Tim, back to you.
Yeah, that's really interesting back and forth. It was like a Wimbledon match watching you guys volley on these points. That was great. Andy, we haven't forgotten about you. We're going to do a quick little lightning round. I'm going to give you 2 questions in the lightning round, Andy. The first one is, how should investment managers launching a retail private capital product think about the risk of private litigation?
I appreciate the lightning round. I'll keep it brief because nobody likes to hear from the litigators as the issue of last resort. The first and only answer to your question is relationships, relationships, relationships. Everybody who's represented a good fund manager knows that they develop relationships of trust with their limited partners over decades. Good managers retain limited partners. They work together. They collaborate. They understand each other. That dynamic is one around which a good fund manager can build its business and eventually an empire. The entire landscape changes once you go over to the public side. And I think dealing with public shareholders who have different motivations for purchasing interest in your company is an entirely different prospect than dealing with an investor who's given you a good amount of their net worth and trusted you over decades to grow it. And so that springs the types of disputes that fund managers may not be used to dealing with. Just to tie it all back to where we began on what Brother Jeremy was talking about with some of the structures that we see in the closed-end fund space, right? A lot of these are closed-end fund styled structures, and anybody who knows the public space knows that leads to activism. Fund managers are not used to having shareholders acquire their company's stock when it's trading below NAV and calling for a change of control in the board and liquidation of the stock. That's kind of an offensive prospect when you think about a fund manager's position. All of that changes in the context of a public company. And so it really requires a fundamental shift in perspective in terms of what you're going to be focusing and dealing with as a manager of a public company.
Thanks, Andy. Second question of the lightning round. Does the nature or number of the investors in retail private capital products, in your mind, change the likelihood of private litigation, the nature of the potential claims, or the potential risk and outcomes?
I like softball questions and lightning rounds because they make for lightning answers. And the answer here is yes. When you are dealing with a broader array of investors, you are dealing with more potential issues. You think about your typical fund manager who's operating pursuant to a 3C7 or a 3C1 exemption. Most of their limited partners are either qualified purchasers or at worst accredited. They are very sophisticated investors who signed very extensive subscription documents and agree to extensive provisions in limited partnership agreements. They know exactly what they're buying into, and they get disclosures up the wazoo because they have an incredible fund formation attorneys like yourself, Tim, who are going to ensure that those disclosures are adequate and that the manager is protected. When you are dealing with shareholders, you don't have that kind of blanket of protection that Tim Clark gives you when he's launching your fund, right? The disclosure issues in particular can come from anywhere and everywhere. Some investor somewhere is going to say that something you said was material or something that you didn't say was material. And so to answer your question is, it's going to exponentially increase the host of issues that you're going to have to deal with when you're going into the public company space.
Great. Thanks, Andy. David, you get the very last question of the pod. And the question is, what should asset managers entering the retail private capital space do to mitigate risks associated with entering the private capital market?
Thanks, Tim. So there are measures that asset managers entering the retail sector can take throughout the life cycle of the retail vehicle to mitigate the regulatory, litigation, and reputational risks that we discussed. These measures include upfront structuring considerations, building a compliance program that is tailored to retail vehicles investing in private capital, and then how you implement those policies and your monitoring activities. So I'm going to elaborate on a few of these measures and pull together the great insights that my colleagues have provided. First, and most fundamentally, sponsors should determine upfront the type of retail vehicle that is best suited for the strategy. Tender offer funds, interval funds, BDCs, no structure is inherently, quote, better, but some are better suited for a particular strategy. For example, tender offer funds provide greater flexibility regarding the timing and frequency of redemptions and allow for more time between the redemption of the shares and the actual payment of cash to shareholders. So if it is a strategy that involves investing in private funds or other assets where the receipt of cash may take additional time or where the optimal timing for doing a redemption may vary, tender offer fund may be the best suited vehicle structure for that strategy. Also at the upfront planning stage, sponsors will want to consider the intended investor base. Do they want sub-accredited investors, which can carry with it additional litigation risks that Andy mentioned, or will they want higher threshold investors, which will limit the pool of investors or potential investor base, but can also play into the calculus of regulatory and litigation risk. Liz and I talked as well about distribution. Consider upfront how your product is going to be distributed, which distribution partners are you going to have. Next, after determining the vehicle structure that is most appropriate for the strategy, investment advisors should enhance their compliance program where needed to address compliance challenges that are related specifically to managing retail vehicles. They may have policies and procedures for managing conflicts in the private fund context. That's going to be a very good starting point for addressing conflicts in the retail context, but it's not the ending point. We talked about investment allocation and other conflicts of interest that can be posed by managing a retail vehicle alongside a private fund. We need to identify what those conflicts are, how there are additional conflicts or maybe more acute conflicts by adding the retail vehicle to your business line and having policies and procedures that address those. Jeremy mentioned the co-investment relief. Investment advisors should plan for obtaining the co-investment exemptive relief from the SEC. It can take time to get that relief. You'll need to plan for that. You'll need to understand how you're going to operate and manage until you get that relief. And then after you get the relief, there are processes and requirements that you need to make and conditions you need to comply with to satisfy that relief. So that's definitely another thing to think about. And last, we talked about valuation, disclosures, and practices. Investment advisors will need to confirm that they have their valuation policies, procedures, and methodologies that are tailored to the types of less liquid investments or hard to value assets that these retail private capital vehicles are going to invest in. That will be a protocol for model governance and testing, how you document your assumptions, when you will adjust the models, and when you may have to override your model output. Also, with building a compliance program, there's resources and human capital to successfully manage a retail fund that invests in private capital. And to meet these additional compliance obligations, you may need additional or different personnel or personnel with different skill sets than in the private fund context. That's compliance, but that's also investor relations team members that are familiar with retail investors and retail performance metrics. And it's finance and operations team members to help manage the redemption process and to manage liquidity in light of the asset coverage limits. Also, the board of directors, including the independent directors, identifying who these directors are, having some in reserve in case there's changes, really recruiting them and retaining them can be important. It's a critical role and is something that's going to be new or different to an investment advisor that's been used to just private funds. The last thing I'm going to say before wrap up is that compliance is dynamic. It's not static. This compliance program includes not just having the policies and procedures in place, but monitoring and testing and refining policies and practices as appropriate. We talked about one example is with the third-party service providers in terms of valuation or in broker-dealers. It's critical to do the due diligence up front, but it's also critical to monitor these service providers on an ongoing basis, both for the quality of their output and for potential conflicts of interest that may arise. So in conclusion, there are various measures that private fund sponsors and investment advisors entering the retail sector should take or consider taking throughout the life cycle to manage the risks that we've talked about: regulatory, litigation, and reputational. By doing this, this will position them not only to manage those risks, but to best benefit from the opportunities that retailization affords both to asset managers and to investors.
Thanks, David. That's it for this podcast. Thank you, Melissa, David, Andy, and Jeremy for joining me today. My rule of meetings is the following. It's a good meeting if you learn something new, and a bad meeting if you don't. By this measure, I thought today's podcast was terrific. Thanks to your insights on this important topic in private capital. Stay cool, everyone.